So the Fair Credit Reporting Act is a federal law that protects consumers' credit information. It was first published in 1970. So the purpose of the FCRA, it ensures that the accuracy and fairness of the consumer information, it protects the privacy of the consumer, and it gives victims of identity theft rights. Who does it apply to? It applies to credit reporting agencies, CRAs, such as TransUnion, Equifax, Experience, medical information companies, tenant screening services, and businesses that uses consumer reports for credit, insurance, or employment purposes. Now, the rights of the consumers, you have a right to place a security freeze on your credit profile to prevent new credit applications from being approved without your consent, to place a fraud alert on your credit file for 1 year or for 7 years, and request copy of transaction records related to identity theft, right? So there's a lot of things that must be done when it comes to the FCRA. But let's go to the CFPB and see what the CFPB is talking about. So for those of you who don't know, so GLBA is the Gramm-Leach-Bailey Act, right? So this is the Gramm-Leach. So there are several federal laws that protects you. And the ones that I like the most is the Gramm-Leach-Bailey Act. I like the Equal Credit Opportunity Act. We have the FDCPA, and we have Regulation Z, right? So let's go now to the FCRA, and we're going to talk about some points that Congress has in place for you. So this is where we go to 15 USC 1681. Now, when we go to 15 USC 1681, it brings us to the Fair Credit Reporting Act. Now, in the Fair Credit Reporting Act, it's important that you know why this law is in place and what does it do. So the Fair Credit Reporting Act, for those of you who don't know, it talks about accuracy and fairness of credit reporting. The Congress makes the following finding. What? The banking system is dependent upon fair and accurate credit reporting. Inaccurate credit reports directly impair the efficiency of the banking system, and unfair credit reporting methods undermine the public confidence, which is essential to the continued functioning of the banking system. Now, let me ask you guys a question. Can we have a banking system where there is no confidence in the banking system by the consumers? If the banking system does not have if the banking system does not operate to gain the confidence of its consumers, and there's a run on the bank, what do you guys think is going to happen? What if there's a run on the bank right now? What do you think is going to happen? Drop it in the chat for me. What do you think is going to happen if a run on the bank happens right now? We're going to have a market crash, ladies and gentlemen. We will have a market crash because there's something called, how many of you know about fractional reserve lending? How many of you know about fractional reserve lending? Let's see now.
Where do you find that?
Say again, please.
Where do you find that topic? I mean, where do you find the fractional reserve lending? Where do you find information about that?
That's a very good question. So fractional reserve lending, I'm going to break it down for you guys in a minute. So fractional, F-R-A-C-T-I-O-N, fractional reserve lending is where the bank, so this is the bank, right? This is the bank, dollar signs everywhere. So this is the bank, right? And the bank is going to say, well, Daraine, tell you what, I want you to give us $10, right, Daraine? Give me $10. And we're going to put this in your savings account, right? So Daraine, being happy, goes to the bank and gives the bank my $10 bill, right? Daraine gives the bank his $10 bill. Now, here comes Joe. Here comes Joe that went to the bank, and Joe tells the bank that he needs to borrow some money. The bank says, "Oh, we got $10 from Daraine. We're going to lend Joe $9, right? We're going to lend Joe $9, and we're going to keep only $1 from Daraine." So the bank lends Joe $9, and then the bank only keeps $1 in Daraine's account. Now, Joe pays this $9 back, but there's something called interest that was attached to it. And let's say Joe had bad credit. Joe had a 620 credit score, right? So they lend Joe the $9 at, let's say, 15%. Now, for every Daraine that comes in, the bank lends out 90% because by law, they're only required to keep 10%. Now, the bank lent Joe $9, but Joe paid 15% on that $9. So Joe paid the $9 back plus 15%. And let's say now Mary came and Mary borrowed some money, right? But Mary's a subprime lend. Mary's in the subprime zone. So now that Joe's paid the bank back the $9 plus the 15%, Mary comes to borrow some money. So Mary now borrows $10. So the bank now is lending Mary $10, right? But because Mary is in the subprime category, Mary got a 20% interest rate. And they continued doing this. So the bank had no money of their own, but they kept lending out other people's money and charging what is called an interest rate. So what they got back is significantly more than what they gave out. Remember, all the bank is doing is being a middleman. That's all banks are. Banks are middlemen. Banks take people's money and they lend it to other people. Do you know why a bank was established? So back in the day, it was too much to carry gold and silver around. Right? SILVER. It was too heavy to bring around gold and silver. So what the money lenders did was they created a bank, right? And this bank would house your gold and silver, and then to the people, it would redistribute certificates. So you would have gold certificates or silver certificates. Right? So now I don't have to worry about carrying around all this gold on me for somebody to rob me. All I need to do is carry around the certificate, and the certificate would be redeemable in the equivalent of gold or silver that it possessed. So over time, people got used to the certificate. It was so convenient. It was so convenient, and everybody was so happy that they started using it as money. It's not money, because real money is coin of gold, coin of silver, God's money. But this became so convenient, silver certificates, the gold certificates. It was so convenient that now I don't have to struggle around. Can you imagine King Solomon walking around with $10 billion worth of gold on him? Like, could you imagine the manpower it's going to take to move $10 billion worth of gold? Right? So this now became an acceptable means, and through this system, so-called money was created. So this system now, where it was a redeemable amount. So if you, let's say we had a certificate that says it's redeemable 10 ounces of gold, That's what the certificate was valued. It was valued 10 ounces of gold. So you would bring this into the money lenders and they'll give you 10 ounces of gold, right? But eventually, what happened is in 1970, we came off the gold standard and you were not able to redeem. So before we reached 1970, back when gold, did y'all even know that gold was illegal? It was illegal to have gold once upon a time. Who knew this? Like you could not have gold. It was illegal to own gold because of the war. So I believe it was in the Great Depression between 1925 and 1930. It became illegal to own gold, right? Because there was a world war going on and they did a draw for all the gold. Now, during this time, something happened about 12 years before. See, a lot of you don't know about the Federal Reserve Bank. Guys, there's a lot of things when it comes to wealth and financial management and money management that you need to understand that you will not be taught in school, right? For years, we were against the Federal Reserve Bank because, as you guys know, the Federal Reserve is the only institution that can print money out of thin air. Yes, you heard me right. In order to print money out of thin air, they had to do away with the gold system. Meaning, for every currency out there, there was the equivalent of gold that backed that currency. Did I lose anyone? Did I lose anyone?
Nope.
Nope,
Okay.
we're with you.
No,
All
we're
right.
here.
So understanding how fractional reserve lending works, understanding how money was created, and understanding what they're doing with money now, literally printing it out of thin air. Guys, they're telling you to save something that they are printing out of thin air. Like, you're telling me to go and save money. But just like this, the federal government, well, not the federal government, because the Federal Reserve is not even a bank. And just like this, there's organizations out there that can literally print money in thin air. So we don't chase money, we attract money. How do you attract? Because you can't go print money like the Federal Reserve. You're going to go to jail. They call those counterfeit, right? You will go to jail. So how do you attract the money that's already out there in somebody else's pocket? You need to solve a problem. So this system that was created led to a whole lot of problems. You see, during this system, some smart person decides that, hey, if the banks now are loaning money out, what about Daraine's history? What about Joe's history? What about Karen's history? What about Fabian's history? Wouldn't other banking institutions want to know their histories? Let's create a company that collects all that information. So what they did was TransUnion, Equifax, Experian did.